I have been receiving dozens of comments asking me to start back up the Intelligent Investor series. This series has been one of the highest rated and reviewed series I have ever done on my channel. So I have decided to start it back up and finish the book. We're going to start where we left off by covering chapter 3 of The Intelligent Investor. This chapter is dedicated to covering the history of the stock market so you can gain insights into how stocks have historically performed so you can properly set your expectations for how they should perform in the future. With that said, let's hop right into it by starting on page 65. Prudence suggests that he have an adequate idea of stock market history, in terms particularly of major fluctuations in its price level and of the varying relationships between stock prices as a whole and their earnings and dividends. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the level of the stock market as it presents itself at different times. This page is saying that investors should have an idea of stock market history, its fluctuations, and its relationships between prices, earnings, and dividends. With a brief history of the stock market, you can start to understand when stocks are looking expensive and dangerous or cheap and attractive. The next page is 66, which shows the prices of the S&P 500 throughout different historical periods. I highlighted some of the key periods to focus on, which are 1901 to 1919, 1919 to 1929, 1929 to 1952, and finally 1952 to 1968. During the first period, it took 18 years for the S&P 500 to produce a 12% return. This is a compounded annual growth rate of only 0.63% for 18 years, which is almost nothing. Then from 1919 to 1929, the S&P 500 saw a total return of 236%, which is an annual return rate of 12.7% over those 10 years, and is much higher than the previous period's returns. However, from 1929 to 1952, the S&P 500 saw a decline of 17%. This means stocks lost value over this 23-year period. And lastly, from 1952 to 1968, the S&P 500 produced a return of 307%, or an annual return rate of nearly 11% for 16 years straight. What all of this data shows is that the market can go through long periods where it produces no or negative returns. The stock market does not go in a straight up line, and there can be long periods, decades even, where stocks don't do anything. Having this perspective is important because it can help you properly set your expectations with your own investing. If you're expecting stocks to continue rising consistently over the course of your life, then you're going to be disappointed and probably give up on investing altogether when they experience a period of little returns. On the other hand, if you're aware that the stock market can have these periods, then you can know that it's a normal part of investing and that you should continue to invest through them. But now let's move on to the next page, which is page 67. And this says, comparing the average level of 1949 with that of 1924, we find the annual rate of advance to be a mere 1.5%. Hence, the close of our second period found the public with no enthusiasm at all for common stocks. By the rule of opposites, the time was ripe for the beginning of the greatest bull market in our history, presented in the last third of our chart. This section tells us that during the 25-year period from 1924 to 1949, stocks only produced an annual return of 1.5%. Think about that. That's a quarter of a century where stocks did almost nothing. That's almost the entire time that I have been alive. So me looking at the stock market over my entire life and seeing it do next to nothing would make me question if stocks are even a good investment. Why would I want to own something that's done nothing since I was born? Ben Graham writes that this was the public's perspective on stocks during 1949. However, since the perspective on stocks was so bad, it means that they were actually incredibly cheap and due for a large correction to the upside. The next passage is on page 69 where it says, these 14% and better returns were documented in 1963, and later in a much publicized study. It created a natural satisfaction on Wall Street with such fine achievements, and a quite illogical and dangerous conviction that equally marvelous results could be expected for common stocks in the future. Few people seem to have been bothered by the thought that the very extent of the rise might indicate that it had been overdone. This quote references the same table we looked at earlier, and how there was a 14% annual returns in 1963. At the time, Wall Street believed these kinds of returns could be expected in the future, which is dangerous, because as we saw, the stock market does not go straight up. In fact, after periods of high returns, the stock market historically has had periods of low returns. It seems as though the stock market has periods of rapid and high returns, then periods of low returns. Therefore, after periods of high returns, investors should remain humble and rational and not expect what's recently been happening to continue on forever. The next page we're going to look at is page 71, which is a table showing key stock market statistics from every decade from 1870 to 1970. For now, we're going to focus on the earnings and dividend growth on the right-hand side of the table. This row shows us that since the 1900s, there were only 2 decades where the earnings of the S&P 500 declined, and only 1 decade where the dividends declined slightly. Now, going back to page 69, Benjamin Graham discusses this data where he writes, "The full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. Only 2 of the 9 decades after the first show a decrease in earnings and average prices, in 1891 to 1900 and then in 1931 to 1940. And no decade after 1900 shows a decrease in average dividends. Today's investor cannot tell from this record what percentage gain in earnings, dividends, and prices he may expect in the next 10 years. But it does supply all the encouragement he needs for a consistent policy of common stock investment." The key takeaways here are that the earnings and the dividend growth of the S&P 500 is much more stable than its price. Additionally, while you may not know what returns you're going to get over the coming decades, you can take comfort in knowing that historically, almost every decade has produced positive returns on stocks. As a result, investors should remain encouraged to continue investing consistently for the long term, regardless of what's currently going on in the stock market. Now let's head back to the table on page 71, but this time focus on the average price to earnings ratio and the average dividend yield of the S&P 500 in the decades following 1941 and 1961. Here you can see the price to earnings was only 9.5 in the first period and had a dividend of 6.3%. In the second period, the price to earnings nearly doubled to 18.1 and the dividend yield nearly halved to 3.2%. On page 70, Benjamin Graham discusses this, where he writes, "A striking feature of Table 3-2 is the change in the price-to-earnings ratios since World War II. In June of 1949, the S&P Composite Index sold at only 6.3 times the applicable earnings of the past 12 months. In March of 1961, the ratio was 22.9 times. Similarly, the dividend yield on the S&P Index had fallen from over 7% in 1949 to only 3% in 1961. A contrast heightened by the fact that interest rates on high-grade bonds had meanwhile risen from 2.6% to 4.5%. This is certainly the most remarkable turnabout in the public's attitude in all stock market history." This passage is important because it's one of the first times Ben mentions bond yields in comparison to stock prices. He says that bond yields increased to 4.5% by 1961, which meant bond yields were higher than the dividend yield of the S&P. In addition, stock prices became much more expensive, which is a reflection of the public's attitude and willingness to own stocks. The next important passage is on page 73, where Ben Graham gave a warning about the stock market levels of 1959. At the beginning of 1959, we found the DGIA at an all-time high of 584. In sum, we feel compelled to express the conclusion that the present level of stock prices is a dangerous one. It may be well perilous because prices are already far too high. But even if this is not the case, the market's momentum is such as inevitably to carry it to unjustified heights. The DGIA advanced to 685 in 1961, then fell a little below our 584 level to 566 later in the year. Advanced again to 735 in late 1961, and then declined in near panic to 536 in May of 1962, showing a loss of 27% within the brief period of only 6 months. At the same time, there was a far more serious shrinkage in the most popular growth stocks, as evidenced by the striking fall in the indisputable leader, International Business Machines, from a high of 607 in December of 1961 to a low of 300 in June of 1962. This period saw a complete debacle in a host of newly issued common stocks of small enterprises, these so-called hot issues. Many of these lost 90% and more of the quotations in just a few months. There's a lot to unpack here. So to start, in 1959, Ben gave a warning that stocks were looking expensive, and 3 years later, they fell to below the prices they were trading at the time of his warning. At the same time as the S&P 500 was falling, growth stocks saw an even more significant decline. IBM, which was one of the hottest stocks at the time, saw its share price fall by more than 50% in just 6 months, which tells us that in stock market declines, the most overvalued and exciting stocks can see an even larger decline than the overall market. Additionally, Ben tells us that during this period, hot IPOs lost 90% or more of their values within 6 months of becoming publicly traded. This is the first time Ben mentions IPOs, and how there tends to be more of them when the market is hot, and how their following returns tend to be very poor. In conclusion, when there's a large amount of IPOs happening, it can be an indicator that the stock market is becoming expensive. The next page we're going to discuss is page 77, which contains another very important table. The key data we're going to focus on is the high-grade bond interest, also known as the bond yield, and the 3-year price to earnings of the S&P 500, the 3 years earnings yield of the S&P 500, and the stock earnings yield divided by the bond yield. Now, in 1958, we can see bond yields were 4.12%. At this time, the price to earnings of the market was 17.6, which is an earnings yield of 5.8%. What this means is that stocks in general were offering higher yields than bonds in 1958, as you can see by the stock earnings yield divided by the bond yield being above 1. This ratio shows us that the stock yields were 41% higher than bond yields at the time, which means investors were getting higher yields or returns by investing in stocks instead of bonds in 1958. However, take a look at what happens over the next few years and pause the video if you need to. By 1971, bond yields increased to 7.57%. At this time, the price to earnings ratio of the market was 18.1, which is an earnings yield of only 5.53%. What this means is that in 1971, bonds had higher yields and were offering more returns to investors. The earnings yield bond yield ratio was also well below 1, which means that stocks were less attractive and more expensive than bonds. Now let's head to page 78 to see what Ben Graham has to say about all of this. The 3-year price to earnings ratio for the market was lower in October 1971 than at the year end of 1963 and 1968. It was about the same as in 1958, but much higher than in the early years of the long bull market. This important indicator, taken by itself, could not be construed to indicate that the market was especially high in January of 1972. But when the interest yield on high-grade bonds is brought into the picture, the implications become much less favorable. Our final judgment is that the adverse change in the bond yield-stock yield ratio fully offsets the better price to earnings ratio for late 1971, based on the 3-year earnings figures. Hence, our view of the early 1972 market level would tend to be the same as it was some 7 years ago, that it is an unattractive one from the standpoint of conservative investment. Ben Graham states that even though the price to earnings of the market had hardly changed from 1958, the market was still much more expensive and less attractive. The reason is because bond yields had risen so dramatically, and by 1972, were offering investors much better returns than stocks. Bond yields are also known as the risk-free rate, or the rate of return that an investor can get without taking on any risk. Therefore, if stock yields are below bond yields, then it means investors are accepting lower returns and more risk by buying stocks. This is why Benjamin Graham says that the change in bond yields fully offsets the better price to earnings ratio that stocks had in 1971. Or in other words, when you factor in bond yields to the valuation of the stock market actually looks very expensive and unattractive. This is an incredibly important point across the entire book, because it's a clear example of Ben Graham discussing how bond yields should be factored into stock valuations, and how investors should consider the yields stocks offer versus bonds when they are valuing stocks. The next page is page 80, which is now the commentary on chapter 3 by Jason. In this chapter, Graham shows how prophetic he can be. He looks 2 years ahead, foreseeing the catastrophic bear market of 1973 to 1974, in which US stocks lost 37% of their value. So Graham was right in his analysis of stocks looking unattractive in 1972, and by 1974, stocks lost 37% of their value. And remember, the reason stocks looked unattractive in 1972 was because they weren't offering nearly as much of a return as bonds, which signaled to Graham that the market was being irrational and overvaluing stocks. Now heading back over to page 80, this says, since stocks had always beaten bonds over any period of at least 30 years, Stocks must be less risky than bonds or even cash in the bank. And if you can eliminate all the risk of owning stocks simply by hanging on to them long enough, then why quibble over how much you pay for them in the first place? In 1999 and early 2000, bull market baloney was everywhere. On December 7th, 1999, Kevin Landis, portfolio manager of First Hand Mutual Funds, appeared on CNN's Moneyline telecast. Asked if wireless telecommunication stocks were overvalued, with many trading at infinite multiples of their earnings, Landis had a ready answer. It's not mania, he shot back. Look at the outright growth, the absolute value of the growth. It's big. On January 18th, 2000, Robert, chief investment strategist at Kemper Funds, declared in the Wall Street Journal, "It's a new world order. We see people disregard all the right companies with all the right people with the right vision because their stock price is too high. That's the worst mistake an investor can make." In the April 10th, 2000 issue of Business Week, Jeffrey M. Applegate, then the chief investment strategist at Lehman Brothers, asked rhetorically, "Is the stock market riskier today than 2 years ago simply because prices are higher?" The answer is no. But the answer is yes. It always has been, and it always will be. This is another important passage, because Jason is pointing out one of the main arguments you'll hear all of the time in the stock market, which is that if stocks always produce returns over the long term, then why should we care about how much we pay for them? He then provides examples of portfolio managers during the tech bubble and how they believed the market had changed and that people not buying stocks at their high prices were making the biggest mistake an investor could make. Well, let's see how this turned out for those portfolio managers. Let's head back over to page 81 and finish off the sections at the bottom here. From 2000 to 2002, the most stable of Landis's pet wireless stocks, Nokia, lost only 67%, while the worst, Windstar Communications, lost 99.9%. Froelic's favorite stocks, Cisco Systems and Motorola, fell by more than 70% by late 2002. In April 2000, when Applegate asked his rhetorical question, the Dow Jones Industrial stood at 11,187, and the Nasdaq Composite Index was at 4,446. By the end of 2002, the Dow was hobbling around the 8,300 level, while the Nasdaq had withered to roughly 1,300, eradicating all of its gains over the previous 6 years. These portfolio managers all saw losses of 60 to 99% over the past 2 years. So yes, paying ridiculously high prices for stocks does increase your risk, and it does not guarantee that you're going to make money. In fact, the more you pay for a stock, the higher its risk becomes. So avoiding expensive stocks is one way that investors can lower their risk and reduce the chances of them losing money. Now, moving on to page 83, Jason continues by writing, "As the enduring antidote of this kind of bull market baloney, Graham urges the intelligent investor to ask some simple, skeptical questions. Why should the future returns of stocks always be the same as their past returns? When every investor comes to believe that stocks are guaranteed to make money in the long run, won't the market end up being wildly overpriced? And once that happens, how can future returns possibly be high?" Graham's answers, as always, are rooted in logic and common sense. The value of any investment is, and always will be, a function of the price you pay for it. By the late 1990s, inflation was withering away, corporate profits appeared to be booming, and most of the world was at peace. But that did not mean, nor could it ever mean, that stocks were worth buying at any price. Since the profit companies can earn are finite, the price that investors should be willing to pay for stocks must also be finite. As an investor, you cannot be willing to pay any price for a business. At one price, an investment may make sense, but at another price, it won't. Therefore, you need to be consciously thinking about the price you're paying for your stocks, because your future returns and the success of your investments entirely depend on the price you're paying. Let's continue by heading back to the book and reading the bottom of page 83 now. Even though investors all know they're supposed to buy low and sell high, in practice, they often end up getting it backwards. Graham's warning in this chapter is simple. By the rule of opposites, the more enthusiastic investors become about the stock market in the long run, the more certain they are to be proved wrong in the short run. At this point, Graham would ask one simple question. Considering how calamitously wrong the experts were the last time they agreed on something, why on earth should the intelligent investor believe them now? This page states that investors typically end up buying high and selling low. And the reason is because people tend to buy stocks when the market has already been going up and therefore has already become more expensive. As we have seen, the best time to be buying stocks is when people are most pessimistic about them. It's when people are skeptical about stocks that the prices offer the highest yields and the highest returns. Therefore, when everyone is enthusiastic about investing in the stock market and prices are continuing to go up rapidly, it's actually a point when investors should be careful and do their best to stay rational about the prices that they're paying. Additionally, Graham points out that the experts were dead wrong, so why should an investor trust them going forward? I see this all the time in the markets as well. Analysts will put out these crazy high price targets on stocks as they're going up and lower their price targets when the stocks start going down. They don't seem to provide any real insight to investors, and more so, seem to just follow what stocks are currently doing. Therefore, I agree with Benjamin Graham, and in my own analysis, I don't place any weight on what analysts say or recommend about any stocks. Now let's move on to page 87, which is the last page of this chapter. The only thing you can be confident of while forecasting future stock returns is that you will probably turn out to be wrong. The only indisputable truth that the past teaches us is that the future will always surprise us. Always. Staying humble about your forecasting powers, as Graham did, will keep you from risking too much on a view of the future that may well turn out to be wrong. In the financial markets, the worse the future looks, the better it usually turns out to be. This page is meant to keep you humble as an investor. You have to realize that predictions of the future usually turn out to be wrong, so you need to be careful investing in them. If your investment thesis relies entirely on the future of a business being perfect, then you're taking on a lot more risk than you know. Therefore, you need to be careful paying for too much future growth today, because nothing is guaranteed. Lastly, when the future looks bad and people are scared to be putting money into the stock market, is actually when it's the best time to be investing. You see, it's when people are worried and skeptical about the future that stocks are at their lowest and therefore offering the most opportunity. So as an investor, you need to be willing to stay rational and look at the value you're getting, both when stocks are falling and when they're rising. You have to be willing to buy stocks as they're going down and people are becoming scared. And you have to be willing to sell them, or at least not buy them, when they're going up rapidly and becoming insanely expensive. That wraps up chapter 3 of The Intelligent Investor, and I really hope that you enjoyed this video. If you did, please remember to leave a like on it, as it really helps get this video in front of more investors who may need to hear or see it. So if you want to help me on my mission to get people as educated as they can be about investing, then again, all you need to do is leave a like on the video. With that said, thank you so much for watching this video. I truly do appreciate it, and I really hope to see you all again in the next one.